Okay, I'm not sure. Can you guys actually type inside the chat? Let me see. I don't understand how I... Right. Are we live? Hey, Daniel. I am trying to get this set up. Give me a second. This is not something that I'm used to. Can you hear me? I mean, I'm... Sezzle? I think Sezzle is a fintech, right? But honestly, I've never really looked into that. I mean, I could. I know it's one of the companies that a couple of you have asked me. Not as many as some of the others that we're going to go through for the next 2 weeks, but yeah, I mean that could definitely be something we look into when we're comparing some of the fintechs at the end of this 2 weeks. So just give me a second. I set up my live stream through YouTube, but somehow or other I couldn't get it to sync with StreamYard, so I had to start an entirely different stream. So just give me a minute as I get this set up. Just 2 seconds and then we'll get into this. Hi, Siba, is that correct? Hi, Siba. I'm sorry if I get your name pronunciation wrong. It's a very unique name. Okay, there we go. All right. Okay, where am I? Sorry. Okay, welcome to the stream, guys. I think this is the first time I'm actually doing this live. I think most of the time previously I've done recorded videos. I mean, I've done a couple of live streams, like I think 2 essentially. One before I moved into this new place, and one last week when I was over here trying to test out the software, but nothing, with a proper setup. So thankfully, I mean, for those of you who have been following for some time, the fog is still here. However, I've managed to get my mic working together with my camera. So unfortunately for you, at least for today, it is the mic. Sorry, yes, it is the mic. It's not the fog, right? Because I'm not going to hold the fog for an hour or so, or however long this is going to take. All right, so oh, sure. I mean, I'll definitely take a look at CISO. I don't think it's a company that I don't like. I just haven't really looked into it because in terms of fintech, I'm fairly well allocated into like companies like SoFi, Robinhood. So which is why I haven't really looked at other fintechs as well. I think Pagaya is another name. So what I might do is that I might like put all these fintechs together into one video and then maybe just review 2 or 3 of them together at the same time. So I think one of the companies that a lot of people have been asking me about is actually PayPal, because I think a lot of people got in the $50 to $60 range, and then after that it went all the way up into the low 90. I think it peaked at around $92, $93, and then from there it fell. So I think that's what we are starting off with. And to be very honest, the reason why we are starting off with PayPal is because of all the 10 companies. This is one of the companies that I'm actually more familiar with, and seeing that this is the first time I am doing the live stream, I don't want to give myself something that is, too far out of my comfort zone, so that as I manage the stream, I can actually do this as well. Right. And then, so yeah, let me see. I think there's 7 of you over here. Am I right to say that? I think there's around 8 of you over here. Yeah, of course, Daniel. I'll do that in a video someday. Thanks. All right. So, hi, for those of you who are new here, my name is Elijah. I live in Singapore. And so, I mean, I guess despite being called a financial hub, I think the level of understanding towards finance and investments in general in Singapore is actually pretty lacking. So for me, I think where I actually learned the most from over the years is, all these communities that I found on YouTube. And I'm at a stage now where my time is a little bit more flexible, because over time, over the last couple of years, my investments and savings basically has taken over my active income. And so that gives me the freedom to focus on this a little bit more, which is something I enjoy doing, the research, breaking things down, hopefully in a way that is easy for you to understand. Because before I actually got into finance, I was working as a primary school teacher. So hopefully that training will kind of help me break things down into an easier way for you to understand. So, at the end of the day, nobody can really tell you what to buy and what to sell, because I think I have followed many communities or followed many creators where people may suggest certain things to buy and sell, and then you may catch the recommendation to buy, but you may miss their recommendation to sell. So I think because of that, what I hope to do, more so than telling you what to buy and sell and whether or not this is a good company to buy or should you sell, I think is to actually bring you through my thought process so that you can understand how I actually look at some of these companies. So what are we going to do here? Why do I call it 10 companies in 10 days? Yeah, I think honestly, the first reason why I wanted to do a live stream, or why I use this framework of 10 companies in 10 days, is to really push myself out of the comfort zone a little bit. Because as it turns out, the moment you turn on the camera for a live stream, it is totally different from recording a video, and it is going to take some getting used to. And so if I stick to my comfort zone of 1 video a week, it's going to be years before I get anywhere. So I'm going to push myself. And so basically what we're going to do is that over the next 10 weekdays, right, other than the weekend, so on the next 10 weekdays, we'll be covering some research about these 10 companies that you guys have asked me about. So the first company, like I said today, is going to be PayPal. And so actually when I took a look at the list of companies that, when I took a look at the list of companies that you guys asked me to cover, there were definitely more than 10 companies on that list. I think at least 12 companies where there were 2 or 3 people asking about it. However, 10 companies in 10 days seem more exciting, but I'll definitely, also find the time later on after these 2 weeks to actually cover those other companies as well. And for those of you who have been listening for some time, SoFi, HIMS, and Grab will not be part of these 10 companies because these three companies are companies that I've spoken about at length on this channel, more so than the others. And I want to talk about these companies individually. Now, I might decide to do it as an extension to the live stream on some days after the main company is being covered. Or I might just do a recorded video. I haven't really decided. I'm more inclined to, just extend the live stream a little bit more and go through those companies on the live stream so that you can actually see how I look at the companies and you can actually see my thought process. So, please, no high expectations. I know I'm probably going to have loads of rooms for improvement and things like that. So if there's anything that you want to see that you think I can do better, leave it down in the comments below, right? So I'm going to take you through the framework of how we are going to be doing this over the next 10 days. It's going to come in two stages. I think firstly, especially if the company has released earnings in Q2, we'll be looking at the earnings. We'll also be using those earnings to fill out some of the Excel spreadsheets that I have created. I think you have seen how I've created some of the spreadsheets for SoFi, for HIMS, and for Grabs. So I have done something similar for all of these 10 companies, but not in as much depth, right? Because this is really just the higher level overview to see whether or not this is a company that is worth our time to really take a look even further or to even take up a position eventually. So I'll be taking a look at the earnings, filling out some of this table, and I'll talk you through some of the metrics that the company has posted, some of the results the companies have posted, and basically my thought process at the same time. So like I said, bear in mind a lot of these companies, because it's based on what you have asked me in the comment section, I might not have as in-depth a perspective compared to some of you and compared to the companies that I usually cover. So if I miss out anything or if I misunderstood anything from a company, please feel free to let me know. So from there we'll be looking at the valuation, and from there we'll be looking at the valuation. Correct. Okay, so this whole live stream, like I said, is for me to document my thought process. So over the last 2 weeks, right? Once we look at the valuation, what I've done is that over the last 2 to 3 weeks, I've tried to somewhat reverse engineer how I spotted companies like SoFi and HIMS early on, to a much smaller extent, Palantir, but I wouldn't give myself credit for Palantir because I really sold out too soon. I think currently I only have 100 shares left. So the whole point of this essentially is to actually break down my thought process. I was trying to recall what are some tangible things that I saw in these companies and try and quantify them so that I can actually use some of these metrics to track and then try and repeat that process again. So I want to apply basically some of this framework to look at other companies and see whether or not we can find some sort of pattern to help us find investable companies that have the potential to become multi-baggers in the future, as long as we let the long-term thesis play out. Okay, so I'm going to start over here. Give me a minute. Okay, so when I look at a company, let me see. I think I prefer this view. Can you see the screen? I'm not sure if I'm sharing it correctly. Oh, I can see Daniel say that he hates PayPal's management because they are a scam. I mean, I guess I didn't really like PayPal's previous management. With Alex Chris, I mean, I don't know. He seems pretty all right to me based on his track record. But this is why I say there's certain subjectivity when it comes to investing. Take a look. Okay, am I doing this right? I think I am. All right. So usually, before I start looking at the company, especially for some of the companies I don't understand, you very simply, especially for those of you who might not have done this before, go to the 10K, which is basically their annual report. In the table of contents, you don't actually have to scroll through. You just click on business, and then you can just go back, and then you just click on the other different segments of the 10K later on. But you click on payments on business, sorry, and then you can actually see what is the company's main growth driver. Let me see if I can make this bigger for you. Okay, so you can see over here, the overview is that at PayPal, our mission is to revolutionize commerce globally. Our products are designed to enable digital payments, simplify commerce experiences for consumers and merchants to make selling, shopping, and sending and receiving money simple, personalized, and secure online or offline. So, okay, it's actually quite a mouthful, including mobile. Right. So basically, they are a payment platform. But I think what I really want to draw your attention to is this last line over here. Because when I create these Excel files, I don't just put revenue numbers in. I think if you have followed my channel for some time, you would realize that with SoFi, we don't just track revenue, we track member growth as well as products. Why is that? Because we can see that that is actually the growth driver for the company. The management doesn't go into office every single day and ask themselves, hey, let's make more revenue. They don't talk about revenue. The revenue is a byproduct from focusing on customers and products, right, in terms of SoFi's ecosystem. And so for PayPal over here, you can actually see how they actually make money. We earn revenues primarily by charging fees for completing payment transactions for our customers and other payment-related services, which are typically based on volume of activity processed on our payments platform. So that is why later on you will notice one of the key metrics that I actually track is the total payment volume or TPV, right? So we also generate revenue from customers for currency conversion, for instant transfers from their PayPal or Venmo accounts to their bank account or debit card, as well as to facilitate the purchase and sale of cryptocurrencies. Now, they do not charge customers to fund or draw from their accounts, and we also earn revenue by providing other value-added services, which comprise of revenue earned through partnerships. Right, and then now they have things like their ad platforms and things like that. So those are other things that are going to drive revenue for the company, albeit these are like smaller revenue drivers. So we can see the main thing from here is that, you know, PayPal primarily is focused on basically making the margins on all these payment transactions. And the more transactions they have on their platform, it means that, you know, they actually make more money. So this is pretty straightforward. And that is how we start building out that Excel spreadsheet, right? So if I am going to bring you to the Excel spreadsheet, this is what you're going to see over here. Let me just share the screen. All right, I'm not sure if you can see this. Just give me a second. Okay, so basically, I think what you are seeing over here, somehow or rather, my Excel is not expanding across the whole screen. Oh, okay. I think there we go. And I think I'll zoom in. I remember, I think when I was testing it, 120 seemed to be more or less where we are. Okay, so what you're going to notice, let me All right, so what you're going to notice over here is that based on what we have read in the 10Q, this is where we're going to start from, the total payment volume, right? So I have plotted, okay, so basically the total payment volume is how regularly people use their accounts, use their platform, sorry, not accounts. And then from there, sorry, I'm so used to looking at things small. I need to remember this is on the live stream. All right, so sorry. So where was I? Let's start again. So we start with the total payment volume. Now, out of the total payment volume, they make a revenue from this total payment volume. And then after they net off all the costs, what you end up with is this thing called the transaction margin dollar. Now, this transaction margin dollar, I would put it over here, is denoted as TM with a dollar sign in their reports. And I think you're going to see it later on. But when I was doing this Excel spreadsheet initially, I wasn't paying much attention to this. It was only later on as I was preparing for this that I realized that this should be a metric that I'm tracking as well. So at the moment, I don't have that. But basically, how you actually get this metric is actually quite simple. And these are two that I believe that we need to track for PayPal. And if these two numbers are going up and to the right, then the company's revenues and net income will follow in that direction. So transaction margin dollar is basically whatever you get from the total payment volume, right? And then from there, there's a take rate. So this take rate will be a certain percentage that gives you your revenue. And then from there, you less, what do you less? I think all the transaction, I think they call it transaction cost. I can't remember what is the exact term that they use. But basically, that is how they make money. People spend money on their platform that is being accounted for under total payment volume. And then based on that, they actually derive a revenue based on a certain take rate. And then you less the transaction cost, and that becomes your transaction margin dollar for PayPal. Right? And then so you can see these are the numbers from the first quarter of 2021 all the way until Q1 of 2025. So I actually haven't put in the numbers for Q1 of 2025. So just give me a second. Let me key in as we go through the numbers together. Okay, let's see. All right, so oops, not this. So Q1 of 2025 we got it. Q2 of 2025. Okay, so I was actually looking at their snapshot over here. Total payment volume, $443 billion. So this represented a 6.4% year-over-year growth. Transaction margin dollar actually came in at $3.84 billion. Okay, so this represented a 7% year-over-year growth. Okay, I'll just write this in later on. I'll include the formula for this. So this is the transaction margin dollar. Now, in terms of revenue, revenue for PayPal came in at $8.28 billion. All right, so if you just double check the formula, revenue as a percentage of total payment volume, you can see over here 1.9%. So this is basically how I see that, this is a trend that we can follow, because if you look over the past couple of quarters, you can see revenue as a percentage of total payment volume has always been around 1.9 to 2%. And I think that is why it is safe to say that this is something that we can assume going forward. And using this, it is so much more accurate than just, slapping on a growth number on their total revenue, because you can actually look from the ground up how the management actually runs the company, right? And then from there, let's see, active accounts, 438 million accounts. 438 million accounts. That means there's a total of 2 million net new accounts. And then these are the growth rates at the bottom over here. Correct? Yeah. Quarter over quarter, 0.5%. Yeah. So later I'll show you the graph, how this actually works out. And then number of payment transactions. Okay. So number of payment transactions is 26. Oops. Right. 6 billion, 6226 over here. On a year-over-year basis, this is also a slight decline. All right, so, but you can see, okay, despite year-over-year being a slight decline, you can see this is inflecting upwards. Transaction per active account is at least it is somewhat increasing, although it fell the last quarter. And then revenue per active account, I believe, yeah, everything is correct. It's back up to around $19. And so this is the framework that we use to actually project out their business if you are actually diving a little bit deeper. So you go to the 10K, you find out not just what is their revenue, but how they make their revenue, and you track the metric, right, that the business will actually follow in order to have their revenue growth. Okay, so that is how we do that. And then from there, let me take a look. Is there anything else? I think, especially if you are following PayPal for some time, I think the interesting thing, or what is actually very bullish for PayPal, is that we start to see Braintree become something that is contributing to total payment volume once again. And then it's driving growth of the total payment volume as well as the transaction margin dollar. And so going into the second half of 2025, I believe PayPal is actually increasing their guidance in terms of their transaction margin dollar. And a lot of this is being driven by Braintree. And so if you remember, Braintree was actually something where when Alex Chris came into the company, this was something that he said was actually mispriced. And then so because of that, he actually priced to value. And basically because of that, they may have lost certain customers because of pricing. But over the last year, actually, you can see this actually inflected upwards. Let me just very quickly share this chart over here. This is actually from their is it this? I think it's this earnings presentation. So you can see over here from this earnings presentation, right, that the where's my mouse? Okay. So you can see over here that basically Braintree's total payment volume returning back to growth once again. And then the numbers that we got earlier from here, total payment volume for $443 billion, revenue 8288, and then transaction margin dollars 3.84 billion. So all these stated over here. Free cash flow is declining. That's not a big deal because I think in general, their free cash flow has been pretty strong. Active accounts, everything is over here. And I think if you take a look, they are raising guidance. And I think this is what I said. I think over the last year or so, I think that the turnaround has taken a longer time than most people expected. In fact, for me, PayPal is actually a company that you see, because I've invested over like 7-8 years, back in 2023, I thought I already knew how to do. Okay, no, I didn't think I know how to do options. I knew how to invest in companies like shares and things like that. I initially started to pick up options back in 2022, 2023, and then I started, thinking that I knew more than I actually did, and I bought calls on PayPal 6 months out, thinking that, oh, you know what, turnaround plays will happen very quickly. So I made two mistakes over here. Firstly, I didn't understand that, for if you're buying leaps, 1 to 2 years out is generally safer. And secondly, it was my first time trying to invest in a turnaround company. And because previously I've invested in companies like Palantir, SoFi, and things like that, I've never really invested in a turnaround company. And I misjudged how long it took for PayPal to actually recover. And so because of that, in my mind, as long as it got to, $80, $90 sometime earlier of 2024, I should be safe because 6 months out, right? However, I bought the call options, I believe, at 36 cents and I exited them only at 3 cents. So I basically lost over $30,000 on that one particular call. And it was a lesson that I had to learn. Turnarounds do take time. So because of that, you give it 2 year. If I use the exact same strike 2 years out, which means end of this year, even then, I might not be making money right now, right? I think so because I gave myself, I think, a $90 strike in 2 months, or sorry, in 6 months, which was middle of or April, sometime March or April of 2024. So I guess even if I went 2 years out, if I hadn't taken profits at the peak, I would still probably be losing money on this trade right now. So like I said, I think sometimes when it comes to turnaround plays, you have to understand the turnaround story, how long it's actually going to take, and whether or not it is going to be something that can be changed fairly quickly, where you actually see the effects of the change fairly quickly, or is this going to be a long implementation cycle? And so this is something that I've learned to spot over the years as I looked at various companies. So recently, a trade on United Health has done a lot better than this swing trade on PayPal back in the day, right? So, but I think I find PayPal an interesting company. Not interesting in the sense that it's a company that I really, really want to invest in. I think comes to a certain point where the valuation is low enough, I might take a look at it to add it back into my portfolio. For those of you who already have it in your portfolio, it's not a dying company. And I think if you have already held it for so long, especially if you're in shares and then you have no real timeline on where's the fog? The fog is over here. I'm not about to hold this for an entire hour, right? So, the fog will be back if I'm recording a video. But I found out how to make this work today. So, yeah. Okay, so the fog will always be here. And like I said, when SoFi is $30, I'm going to get a golden fog. I think some of you have asked me, and I promise you, SoFi $30, we are seeing a golden fog. Okay, so like I said, this is where we are right now. We have understood, okay, that they are raising guidance in the second quarter. Total payment volume has been increasing. Transaction margin dollar has been increasing. And we know that revenue as a percentage of total payment volume has been steady at 2%. So that is the assumption going forward. So those of you who are, looking to build your own models for PayPal, this is something that you have to pay attention to. So then we go to their quarterly numbers. Oh, wait, before that, let me go back to my Excel file. Right. Okay. So before we look at the quarterly numbers, I mean, I want to show you yeah. So I think what you can see over here is the graph of, sorry, I just recovered from a bad flu. Okay, so I think what you can see over here is the growth of the total active accounts. Now, what you're noticing is this blue bars over here. This represents the total number of active accounts. Now, these were actually declining for a period of time, and then you can see them generally back up again. And at the same time, if you take a look at this orange line basically represents the net new additions. Then again, once again, back in 2022, 2023, you can see a very large drop off. And this basically stagnated for a whole year over here. And you can see this number once again starting to rise. Now, I say starting to rise, we only added 2 million accounts, so it's not that much. But like I said, I think this is something that, because it is a turnaround story and PayPal is a huge company. I mean, they already have over 400 million accounts on their platform. So because of that, I don't think we can expect to see super explosive growth over here, but I expect to see the trend of this growth continue, right? So sometime next quarter, we can actually hit 440 active accounts. I think we're at 438 now, right? So let me just very quickly include the new data into the chart over here. Active accounts, sorry, let me just zoom out. Okay, select data. So active accounts all the way until here. It's in net new additions. Right, I believe net new additions are over here. Okay. So yeah, you can see this is increasing over the last couple of quarters. They have consistently added 2 million new members. Okay. Kind of have plateaued a bit, but if we are plateauing at 2 million members, I guess it's better than here where we were losing members. So I hope to see this continue increasing 3-4 million new accounts into their platform. I think that would be pretty bullish for the company. Okay, then we look at their quarterly numbers. I think quarterly revenue just now, we had it coming in at $8.288 billion. And then on a year-over-year number, that represents a 5.1% growth. Let me see. Where's their operating income? Okay, operating income is 1.644 billion. This can all be found on their This can all be found on their earnings presentation that I was looking at earlier. So you go to their investor relations, you can actually get non-GAAP operating income is $1.64 billion. And then, yeah, so you can see when it comes to their profitability metrics, right? I actually track two things. I actually track the year-over-year growth, and at the same time, I also track the margin. Now, these blue lines over here are basically my assumption going forward. Now, what do I mean by this? Because when you are assuming, you can either okay, how do I put this? When you talk about revenue, it's fairly straightforward. You just want to make more revenue this year than you did the previous year. So that is why we are using year-over-year growth as a way to project out revenue. Right. So like I said, we could do it. The more accurate way is to actually do it through the total payment volume as well as the transaction margin dollar. Okay. However, what I like to do is to actually do both at the same time, where I do it where I actually work it out from the bottom up, and then I also take what management has done and then just slap on the growth metric and project out and to compare the two results. I think if you have followed my analysis of SoFi, that's what I like to do. And so in this case over here, why is it that I'm choosing to actually project out margin over growth? Because especially when it comes to profitability, margin is more important than growth, right? Because I think especially as you get more and more profitable, the number gets bigger, the growth rate will tends to slow. But that is not necessarily a bad thing for the company as long as they're maintaining or even slightly increasing margins. And so that is why moving forward, I tend to, especially when it comes to margin, which is where you can see operating income and net income, I actually like to project out my margins rather than my growth rate. So operating income over here, 19.8% operating margin. So that is pretty good. And then let's see, where is my net income? Net income. Net income for, okay, 1261. Okay, again, just drag the formula year over year, so 11% growth. Okay, not fantastic. And I think you can see why paper actually fell after earnings. I mean, the numbers, it was a beat, but it wasn't a super impressive quarter, if you are very honest. Number of shares outstanding. Okay, now number of shares outstanding again. This is getting ridiculous. 977. Okay, so on a quarter over quarter basis and a year over year basis, once again, they are buying back more shares. And because of that, let's see, EPS, does it come into? Yeah, $1.29, right? Gap. Okay, so that is basically what we have. So gap EPS. So basically, this is their quarter's performance. Now, like I said, I don't follow PayPal very, very closely, so I can't tell you for sure whether or not this is good and bad, but I don't have to, because at the end of the day, we're just taking this number, using it in our discounted cash flow later on, and then to find a valuation for the company. So I don't have to make a judgment on whether or not this is good and bad. But if you think about it, they are growing their EPS by around 20% this quarter. They grew their EPS by 58% last quarter, and they raised guidance for the second half of 2025 because they think that they are going to be able to do better. Why they are going to be able to do better? It is because higher Braintree is actually going to be driving higher total payment volume as well as higher transaction margin dollar for them. So I actually expect a increase of their margins to expand, their growth rates of their profitability to expand. And I think towards the end of the year, I'm not too sure. I think it really depends on how. I think it really depends on how well the market is doing, sentiment in the market when it comes to the economy and things like that. But by and large, I think if they are able to maintain the same level of growth or even more, and to actually put up the numbers that they have already promised the market, then I believe if we have a relatively calm, or if we have the Santa Claus rally at the end of the year, I think the market will definitely price that in, right? So okay, let's move on to cash flow from operations. This is fairly straightforward. Where is it? Oh, sorry. So this cash flow from operation number is not in their earnings presentation. You have to go to their 10Q to get it. So give me a second. I am in their 10Q. Cash flow from operations. Up to this point, I hope I am being clear, and I'm not too sure if there are any questions apart from the fog. Okay, let me see. 5, 10Q. Cash flow from operations. All right. Net cash provided by operating activities, 2.58 billion. Okay. Was this down quarter over quarter? Oh, okay, it's up quarter over. 2058. Okay, I'm just formatting wise, I think I save it. Right. Yep, net cash provided by operating activities, $2.058 billion. Now, this is basically just a formula. Let me just double check the formula as a percentage of net income as a percentage of revenue. Am I correct? Yeah. Actually, I was just thinking about this the other day. I should be doing this, but we already have free cash flow margin, so it doesn't really make sense to find the margin for cash flow from operations. I think cash flow from operations usually I'm more inclined to judge it as a percentage of revenue rather than percentage of net income. Yeah, so that's just one thing that I will be changing in this setup over here, because I actually use the same Excel for various companies and then basically copy paste. So certain metrics I still need to make little tweaks to it, especially if you want to do a deeper dive. But this is enough for us to have a general understanding of the company. CapEx spend, let's see, purchase of plant property equipment, 402. Okay, so you can see a higher CapEx spend over here. And then you can see as a percentage of revenue. Okay, so you can see a slightly higher CapEx spend, which is why free cash flow is lower. And then is this number in line with what they reported? Let me take a look. Okay, they reported Let me see. Where did they? They usually give their cash flow numbers quite. Oh, wait, did I look at the wrong number? Net cash provided. Oh, okay. Net cash provided. All right. This is thing I just want to bring your attention to. I just realized the numbers over here that I keyed in are wrong. The correct number. Okay, let me share my screen over here. This is something that if you are building your own models in future, you just have to pay attention to. Where's my screen? Okay. Okay, I'm going to zoom in for you. Hopefully you can see. Okay. Oh, I can draw on this. Oh, fantastic. All right, you can see on 30th of June 2025, net cash provided 898 million. Now, how did I get that 2.84 billion numbers later? I'll show you. So capex over here, and then this is how they get their free cash flow. So let me just transfer this one number in first. Oh no, wait. Let me go to the next slide. So why did I actually misunderstood this? Because let me share this tab instead. So what you're going to see over here is that if you take a look at this number, let me zoom in once again. I was looking at net cash provided by operating activities, and then if you see over here, this number 2.058. Now, the reason for that is because if you take a look at this over here, it says 6 months ended June, right? So you got to pay attention to that when you are keying in the numbers. And that's why it's always good to double check your work, right? So because of that, let me use the correct numbers. All right. 898. One, this is better. 206. All right. So you can see, so CapEx spend actually didn't increase much as a percentage of overall revenue. It's around 2.5%. So that's great. However, free cash flow actually declined, right? It's still declining year over year. Again, that's possibly why people are a little bit, or the stock has basically sold off. Okay. So, but like I said, again, this is not something I'm worried about. They're reinvesting into the business, and I think we can expect to see free cash flow rise again in the coming quarters. Give me a second. Okay, so once you get all these numbers, okay, let me just show you the nice graphs at the bottom. So all these graphs will basically be over here, and I think you can see the revenue number has been rather inconsistent. I mean, you can see it's fairly cyclical, that in Q4, that spending tends to go up. So that's part of nature of understanding their business. There's nothing to be concerned about. So this dip from Q4 to Q1, like I said, nothing to be concerned about, because that it tends to be a feature of their business, right? Q1, Q2, Q3, and then Q4, sudden spike. But I think what is concerning, or what has concerned investors over the years, is basically this dipping orange line over here, where the growth of revenue has been really slowing down. And then this is something that we'll consider when we evaluate the company later on. Operating income, you can see this is slowly starting to rise. The trend is not really, I mean, you can see generally, I guess, if you draw this thing called a line of best fit, you can say it's an uptrend, but I think margins have been more or less between 15 to 20%, right? Nothing spectacular, or no big significant changes. Similarly for net income as well. And I think where we really see the biggest change is this last graph over here. This last graph basically represents the shares outstanding and compared to the earnings per share that PayPal has been posting. So you can see the blue bars representing the number of shares outstanding. This has been declining over the years, and at the same time, you can really see this inflection point for their EPS as well. So I think we can expect to see that continue as they continue to buy back shares going into the future. Right. So this is something that we need to assume. Now, when you run so using all these numbers, what we actually did is to actually to get basically an annualized number. You basically try and project out what they make for the entire year. Of course, we only have data to 2024, 2025. We are still currently in it. 2 quarters have passed, so you can actually use whatever projections you want. But I think where I really want to point your attention to is this page over here. I think some of you have seen this, at least screenshots of this that I've used when I analyze previous companies. So I want to talk you through how I look at this particular page over here. So this is basically the way I do a DCF. It's a fairly simplified form. I don't really account for net working capital. I mean, you can definitely if you want to be really, really accurate, but I do believe that at the end of the day, it's a balance between accuracy for academic sake as well as simplicity to understand the business. So does it make a difference? It definitely does. Does it make a significant difference that I feel like I always need to add it in for the additional amount of work? I think it can be argued either way. I think for my purposes, at least what works for me, this is actually good enough, right? So very simply, now, first thing you need to do is to find the weighted average cost of capital. Now, I have a formula over here. You can go and try and fill out, okay, the debt number will be filled in for you. Cost of debt and all that will be filled in for. Basically, you can all find this information on their disclosures, or if you're lazy, and sometimes I am lazy, you can just go on to Google and type WACC for PayPal. Now, I think this 8.8% WACC that you're seeing over here is what I got using their last data, which means I haven't updated their numbers on their debt and equity and things like that. But if I look at some of, let me just show you. Like I said, does it make how accurate do you want this WACC to be? This it's really up to you. I think I think the academics will definitely say you must calculate your WACC. However, so some people just take the number that they find online. Now, this can really, really affect the valuation. Basically, it's the expected returns. I think I'll dive a little bit more into WACC in future. This is not the video to do it. But let me just show you, if you want to have just a high-level understanding of the company, just Google it, honestly. Does it make much of a difference? Yes, it does. Let me just show you. Okay, you Google WACC for PayPal. What you're going to see over here, the first on Guru Focus, they tell you it is 9.46. On this value investing IO, they tell you is 8.3. And on Alpha Spread, they tell you is 7.85. So you don't really, it's basically somewhere in between, right? 7.85 and 9.4. So, which is why if you go back to our Excel sheet, you can actually see 8.8 is a fairly Yeah, I think it's a fair estimate to use. Now, what I'm going to do is I'm going to update the debt number over here. How much cash do they have on their balance sheet? You just have to go to their 10Q. Okay, let's take a look. For PayPal, okay, so they have reduced their short-term investments by a fair bit. 6.8. Let me see. Let me add 6688 plus 3320 10008. So cash 10008. Long-term debt. Where is the long-term debt? 11,296. Okay, nothing much has changed over here. Number of shares outstanding. I don't know why is okay. I'm actually using the formula that Microsoft pulled over here. 955. Let me just double confirm. Oh, okay, it is. As of July 2025, there were 955,000 shares outstanding. If you go, I'm just going to show you over here before I think I'll do a summary at the end. I think this is more or less for those of you who are here, you're going through the entire process with me so that you can see where I take it from, because I think people like to take numbers or use numbers in their calculations, but they don't actually show you. So you can see as of July, 955 million shares. So not 977, which we were using earlier. So let me just change that in our spreadsheet. Okay, wait. Here we go. Quarterly numbers. Now here is 955. Okay, so I mean, I definitely think that, yeah, between Q2 and now, there are definitely going to be some changes. All right, I think we are fine. The number 955. All right. Okay. So this is not a video where I'm going to teach you the mechanics behind the discounted cash flow. I hope you understand. Basically, if you take a look over here, we are just assuming PayPal grows their revenue 6% this year. Why 6%? Like I said, this is one of those where you're just slapping the number on because you're not doing a super in-depth calculation. But there's also a reason why I am okay with this, because in this discounted cash flow, we're actually assuming a growth rate and then working backwards to see whether or not it is at fair value today. So the assumption over here for PayPal is that in 2025, PayPal grows their revenue by 6% year over year. Now, thereafter, in 2026, all the way until 2030, let's say that they slow down their revenue growth from 6% to 4% for 2 years, 3% for further 2 years, right? Okay, and then they just maintain 3% all the way. And then their cash flow from operations, the margins has been around mid-20s. So I would say that if they can expand this slightly to 25% as they stop their reinvestment into the business, then okay, this can maintain 25% in 2026 and beyond, slightly higher than where we are today in the 23% range. And then capex as a percentage of revenue, this has been pretty standard around 2.5%. And so that's what we're going to assume for the rest of the years, right? So the cash flow number is over here, and then you discount it back to present value. Now, with all of this, you get a perpetual, if you use a perpetual approach, oh my goodness, my English, you get a share price of around $142.28. On a multiple basis, you get $113. Let me just double check what is the EV to EBITDA for PayPal at the moment. Am I using something that is too conservative, or is this all right? Give me a second. PayPal. PayPal EV to EBITDA. Yeah, okay. I mean, currently they're trading at a 10.5 times EV to EBITDA. So, I mean, 12 times as they recover, I don't think it's too far-fetched Some people might want to give it a little bit of a higher multiple. That's up to you. I think for me right now, they're at 10.5. I'm assuming that they will get back to some form of growth during that period. Okay, they may actually have a higher multiple, but thereafter, as they level out, I think ending at around 12 times is a fair estimation. If you bump this up to 13, you can get a higher number. But like I said, when we do our valuation, we want to be as conservative as possible. Now, what I've done over here is taken this $142 and $113. Basically, I have gotten an implied price over here. Now, this implied price is basically the average of the two numbers that we have found at the bottom. And then I give a margin of safety. Now, why? How do I decide how much margin of safety do I give? It really depends on how much confidence I have in a particular business. So in terms of PayPal's case, they have a lot of cash on hand. They are not going to become, a growth company suddenly again, but they are going to basically turn the company around. Do I need a margin of safety? Definitely I do. Is this company, I'm worried that it's going to go out of business, but I want to give a larger margin of safety? Not really. So 10% seems to be fine. So a 10% margin of safety from $128 puts the price target for PayPal today at $115, which means that if you compare to where they are today, trading at around 60, what are they today? $69? What's the price of PayPal? Okay. It says around $69. Am I wrong? PayPal. How much is PayPal trading at today? Well, it's a pretty great day in the market today. I wasn't even looking. When I started this live stream, Oscar and Grab were holding up my portfolio. I mean, I guess now Grab is the only one that is green in my portfolio. PayPal is $69.58, which is pretty accurate as to what the Excel spreadsheet is actually giving us. So, from here, I think you can see that there's still a 66% upside, which is why this company, on a valuation perspective, it is still fairly undervalued. However, the valuation is, I mean, it's not that it's not important, but really it's that Warren Buffett quote that everybody, I think it's Warren Buffett, but there's that quote that everybody likes to use over when it comes to overvalued companies, right? People say that the market can be irrational longer than you can be solvent, and so because of that, they say that people tend to use it as a way of saying you might not want to short companies that you think are overvalued because the market can stay irrational. But I think in the same way, the reverse is true. The market can keep share price depressed for a longer than reasonable period, and so I learned that the hard way by having leaps on PayPal. But I think after the last quarter, do I really want to? Am I looking to open a position in PayPal? No, not really. Not at $70. Am I worried for any one of you who have gotten in the 60s? Also, no. At the same time, I think this is a fairly decent company. Now, I did say how we are going to round this up really is by taking PayPal through this framework that I reverse engineered. Now, this framework is not set in stone. I'm just taking some of these companies through the framework, and then we will revise it as we go along. All right. Give me a second. Let me pull this up. So, by the way, why I got this tick over here is if I can, this tick over here, basically, as long as the potential upside is more than 50%, basically, it's to me fairly investable, at least over the next year. But like I said, if you look at the history of PayPal and this company in general, the market hasn't really been giving it the respect that it deserves. I guess you could say it deserves. And so because of that, I think you have to be fairly careful when you enter into this position. All right. Now, let me pull this up. All right. So what you are seeing now is basically this checklist that I have put together. Now, I am not someone online trying to claim that this is the checklist for you to find your next multi-bagger. No. Okay, this is not, I'm saying this is not. What this is basically, in the past, I have quite haphazardly found companies like Palantir, SoFi, HIMS, and to a certain extent, I know how I found these companies. Like I knew that, the total addressable market for Palantir is huge. How huge, I couldn't really quantify. I just know that it is huge, and the revenue will eventually grow faster than the total addressable market. Right? So because of that, it's things like this that I have tried to quantify to the best of my abilities, reverse engineer backwards to look at some of these companies and to see where they fit in. Right? So for example, HIMS, I know that they are a company where I know that they are a company that can come up with new verticals very easily, so that's why there's optionality over there. And because of that, it's something that I look for in a growth company. It's something that I look for in a young company that is looking to go up against the big boys. And I think it's because of things like this that make me bullish about the company, but I've never really quantified it. So what I've done is that I looked through my investment thesis on Palantir, on SoFi, on HIMS. I lost a lot of the notes that I've made along the way. But there are certain things that I look at, and it's more of a top-down analysis over here, where we look at the total addressable market, and then the business model and the moat. And from there, we dive into the financials, the revenue, the gross margins, balance sheet, and cash flow. Okay? And then after that, we look at insider alignment, which is the CEO as well as the buybacks. It's not really just the CEO. I guess you can say it's the management team, but I think more importantly, the CEO. And then after that, we look at how they handle risk, right? So in PayPal's terms, they basically divested from a lot of the unprofitable segments of the business, and I think that is a way of lowering the risk. So basically, what I have done, what you're going to be seeing a lot of over the next 2 weeks, is that I'm going to change the values over here. So you can see, right, total addressable market for PayPal, yes, the TAM is big. It's more than 10 times of its current revenue because it's the payments market. So that's why this gets a 1.5 score. Okay. Now this 1.5 score is actually a maximum. How do I know that? Because everything is over here. This is all the back end of whatever we are doing in front. If the total addressable market is more than 10x of the revenue, you get a 1.5, 5 to 9 times, 1, and then less than 4 times, you get 0.5. Now, my minimum score, in certain cases, it's going to be -1. In certain cases, is 0, and certain cases is 0.5. Now, how I decide these numbers is actually pretty arbitrary because to me, why the minimum score for certain segments is -1 is because if a company doesn't perform the action or doesn't live up to the expectation, then that actually hurts the business, right? So for example, let me bring you back over here. If the company doesn't reduce debt, no action taken despite the presence of risk, then it actually harms the company, right? So because of that, I'm taking away points from the total score. However, if something is neutral to the business, okay, if something is neutral to the business, then then basically we give it 0 as a scoring. So for example, in terms of moat, okay, I think you can argue this over here. I think you can argue this over this point. I think for me, how I see it is that there are 6, or perhaps 7 possible modes, right? Switching cost, network effects. No company can have every single one of these modes. Some is just due to the nature of the business that they're in. So not having a moat is not necessarily going to hurt a company, whereas having a moat is definitely going to strengthen a company. So that's why I choose to think that if there is no moat, or if the moat is weaker, easier to replicate, it's neutral. It's not a good thing, but neither is it a bad thing, because that's where this valuation again comes in. There's a little bit of subjectivity where it comes to our valuation and the way we understand companies. So at least for me, if you don't handle a risk to a company, reducing debt, exiting unprofitable segment, that is directly going to hurt your business. Now, not having a moat in a certain area can be because of many reasons. Having a moat that is easy to replicate can also can also be a bad thing. But if you think about it, every young company out there, HIMS, SoFi, and companies like all of them are going to have moats that are easy to replicate while they are still young. It is really essentially only the big companies like Google, like Amazon, like Meta that are having strong and clear moats that are very hard, they are very resilient, they are very hard for people to overtake. So to penalize people just because they have no moat, which could be, like I said, an industry-wide thing, right? Not everybody is going to have low cost, like especially if you are considering a retailer compared to a software company, just because they don't have a low cost advantage doesn't make a particular retailer weaker than a software company for per se, right? So these are certain considerations I have, right? So like I said, if you go back here, -1 if it hurts the business, 0 if it's neutral to the business, and 0.5 means that it is not good relative to the market, but it's somewhat additive to the business. So for example, right, a company is operating in a TAM that is 4x its revenue, which means that it's more or less at saturation. We are not sure how much more it can grow. And the CAGR of the TAM is actually less than 3%. So the company can still grow. It is not bad for the, it is not neutral because it is still growing. However, it is not really good for the business relative to the market. It might be right for disruption and things like that, but we are still not pricing it in as a negative per se, because that assumes that there is definitely going to be someone that disrupts their market, right? So that is how I price this, or that is how I score this these categories. So what you can see in the front, we are going to choose from the different segments over here. Sorry. And then after that, it's going to pull from these numbers over here. Now, the total checklist you can see is out of 40. And then there's a scoring over here. So 35 to 40, these stocks are compounders, elite compounders. I mean, I really don't have a better name for it at the moment. Like I said, I just put this together over the last 2 to 3 weeks. I would think of better names in future, easier to remember. 28 to 34, high quality. 22 to 27, story driven. What does story driven mean? It means that it's like a turnaround play. You can see that they're heading in the right direction, but perhaps certain aspects of the story is still not fully manifested, or perhaps certain fundamentals like it's not actually supporting that the story that the company is actually putting out there. 15 to 21, weak or in transition. And I would say that before Alex Chris took over, PayPal was actually in this segment over here. Let's see where they score after that. And then less than 15 basically is an avoid value trap. Like, don't even waste your time. You might as well find a better company, right? So ignore this 18 score over here because some of these numbers are not accurate. Let's basically talk through what we know. All right, give me a second. I'm going to try my best to make this into a recording that I can use and perhaps post a shorter form of this on the channel. So I'm going to try my best, okay? First time I'm doing this, so cut me some slack. Now, in today's video, the first of 10 companies that we are analyzing is actually PayPal. Now, a lot of people have been asking me about PayPal. They have been worried about the performance of the company. Over the past year, the stock ran up all the way to $93 before falling back down into the 60s and recently recovering into the high 60s and $70 range after their Q2 2025 earnings. Now, in their Q2 2025 earnings, they reported certain things that were actually bullish for the company. However, at the same time, because of certain financial metrics, I think people are a little bit concerned about the company. So if I take a look at the revenue numbers, for Q2 of 2025, I think what we are seeing for PayPal is that revenue came in at 8.28 million. This represented a 5.1% year-over-year growth and an operating income of $1.64 billion. And this represented a 19.8% margin. So once again, if you're looking at the operating margin, you can see that the operating margin for the company is actually increasing. Now, on a net income basis, net income margin declined slightly quarter over quarter, but is still up from the previous year, right? Yeah, so it's still up on a year-over-year basis, but it is actually down on a quarter-over-quarter basis. Net income came in at $1.261 billion at a 15.2% net income margins. Now, they have 955 million shares outstanding. Okay, so when it comes to the shares outstanding, there's a slight discrepancy over here. If you actually take a look at the numbers at the end of Q2 when they actually reported 977 million shares in their earnings presentation. But if you look at the 10Q, they put 955 million. So depending on the number that you use over here, if you're using 977 million shares, you get an EPS of around $1.29, and this represents a 20% year-over-year growth. So if you invested into this company, I think where the real bull case exists for PayPal is in the second half of 2025, with various segments of their business actually re-accelerating back into growth. I think Braintree is one of such business segments that is re-accelerating back into growth, and because of the re-acceleration of Braintree, SoFi, I've been talking so much about SoFi, PayPal's management has actually increased guidance for the total payment volume as well as the transaction margin dollar, right? For the second half of 2025, this is due to the increase in some of these other business segments over here. And so because of that, and you combine that with the fact that they are buying back shares at a very aggressive pace, I think we can expect to see their earnings per share continue to increase into the back half of 2025. And if we actually get a good economy, if the macro actually holds up, then I wouldn't be surprised to actually see this company slowly recover over the next couple of months. And then from here, we actually look at the cash flow of the company. Cash flow from operations came in at $898 million. This is down quarter over quarter and also down year over year. And this actually represents 11% cash flow margin, right? Basically, $8.98 million is 11% of overall revenue. Capex came in at around $206 million. So this is fairly steady. Capex, they have been keeping their Capex spend relatively steady at around 2.5% of total revenue. And this gave us a free cash flow of $692 million, which represent 8.3% free cash flow margin. And so because of that, I think you can see, because the margin compression on the free cash flow side might be something that is worrying investors, and that is why you can actually see them actually sell off despite them beating their earnings numbers. So to me, I think if you are a long-term investor into this company, this shouldn't come as a surprise to you. But I think over the long term, we can actually see this, the long-term thesis for this play out. I think for many investors who have been in this company for the last 2 to 3 years, it's a very frustrating time. The turnaround is actually taking longer than expected. But I think if you look at some of the announcements they have made, I think it's actually quite bullish for the company. I think the adoption of many of their new products, things like Fastlane and especially their launch of their stablecoin in future will definitely be things that are going to drive growth for the company. So personally, it's not a company that I'm actually too worried about in terms of the next 5 to 10 year, right? It's not something that I think will definitely, disappear over the next 5 to 10 years. They're not at risk of any bankruptcy and things like that. It's just that the turnaround story is taking longer than expected. So what we're going to be doing is to basically run this company through a framework I have. Now, this framework is basically something I have reverse engineered some of the companies that I founded previously, some of the companies that I've invested in previously, and found some of these characteristics that are common traits among some of these companies, and tried to put them together in this framework and to see where PayPal actually stands among some of my other investments. So I'm going to share with you this Excel file over here. And then basically we are going to take PayPal through each and every single one of these segments. Now, when it comes to the total addressable market, I think it's safe to say that the total addressable market for payments, I think it's over $1.6 trillion, which is definitely more than, sorry, give me a second. I think total addressable markets for payments. Yep. So if you look at sources like Reuters, they actually tell you that the total addressable market for payments is around $110 trillion. So you can see SoFi's revenue is only at SoFi. Oh my goodness, I keep talking about SoFi. PayPal's revenue. Let's try this again. So if you look at the total addressable market is going to be around $110 trillion in terms of the payments market. And right now, PayPal's revenue is only in the $30 billion range. So their revenue the total addressable market as a ratio to revenue is definitely more than 10x. So they get 1.5 points over here. However, the CAGR for the payments market, let's see, Is it going to be growing more than that? The CAGR for the payments market. Well, it depends when you're looking at it. I think it's growing fairly quickly, around a 20 to 30% CAGR, but this is starting from 2022 all the way until 2030, right? Because it is expected to grow to 198 billion by 2030. Let me take a look. So I think it really depends when you look at the total addressable market, which sources that you're looking at. Grandview Research tells us that there's going to be a CAGR of 21% from 2025 all the way until 2030. So okay, I think this is something that we can use. If we are going to grow at a CAGR of more than 10%, we can give them a 1.5 over here. So in terms of total addressable market, we know that PayPal has a very big total addressable market in front of them. And I think that hasn't been the concern with PayPal, that that we think that they are saturated in the market that they are today. I think the concern for PayPal is that this is a market where it's really a race to the bottom, and because of that, the margins of the company might be forced to be compressed. Is this a simple business model? I would think yes. They have added a lot of things to the business, things like their ads platform, stable coins, and things like that. But by and large, people spend money and they just take a cut of that transaction. I think it's a fairly simple business model with clear growth drivers, right? Like we have mentioned, if you take a look at the Excel file, and for those of you who haven't actually watched the live stream, I'll actually try and timestamps the live stream so you can take a look at how we actually went through PayPal's business model. But they start with their total payment volume. From there, they derive revenue based on the take rate, and then once you take out all the transaction related costs, and what you end up with is a transaction margin dollar. So that's why the growth drivers for the company is actually pretty straightforward. There's no recurring subscription model over here. I guess from the merchant side, yes, but not from the consumer side. But this is a repeat purchase model in the sense that people tend to, once people are used to your company, right, as a checkout mechanism, like I save my data onto in PayPal, and because of that, every time I make a purchase on my PlayStation, I go through PayPal. So in a sense, it is a repeat purchase on the consumer side as well. Now, in terms of their moat, I don't think there's a huge switching cost over here. I don't even think it is strengthening. I mean, you can correct me if I'm wrong. I mean, what's the switching cost for not using PayPal? I mean, there are a lot of times where I don't use PayPal. So I would say no, or weak mode over here. Network effects, I would say strengthening in a way. Because the more, and this is not so much about their core payments solution. I'm talking about I'm talking really about how they plan to run ads on their platform, right? And I think the more people that they get on the platform, the more data that they have, they are actually able to sell this data back to some of the merchants that they can use to better advertise to consumers to actually increase to increase the checkout rate. Yes, correct. To increase the checkout rate. Low cost advantage. Do they really have a low cost advantage? Not that I know of. Economies of scale. Yes. Slight mode. Regulatory framework. Now, I think this is where you have to say that PayPal is pretty impressive. I think they are also able to operate in China, and I think they are the only US payment company that is able to operate in China. So regulatory framework, strengthening, clear mode, not insurmountable. I think it's somewhere in between that and fully built. I wouldn't say it's fully built because they are not. Are they really in every part of the world? Not really, but I would say that it strengthens in volatility. I think especially where tensions between nations are getting higher, it's even less likely and it's even harder for new payment companies to actually get any sort of regulatory approval, especially if they are going international, right, beyond outside the borders of the US. Intangible assets, I would say, maybe a little bit. There's a clear mode. It's not strengthening. It's a clear mode, and that clear mode is really the brand value of PayPal. Like people recognize PayPal. It's been around for ages. People trust the brand. It is not insurmountable because previously, I think we have seen, like, although PayPal has always been an option for checkout, because they made it so cumbersome, people will just not use PayPal, right? So it is not an insurmountable mode, but it is there. So that's how we get there. And this mode and business model, you get a 3.5 score. Now over here, you can see this scoring system. I actually multiply this by 1.5. And I multiplied this by 1.5 because I just want to give more credence to the score over here according to the overall value. Now, revenue strength, is the revenue growing faster than the TAM? No, the payments market's growing at 20%. They are slower than that, so they don't get any credit for that. Revenue growth rate, they just grew revenue. Sorry, I just forgot. What did they grow revenue at last quarter? I mean, on an annual basis, they're growing at single digits over the last 3 years, 8 to 6%. However, on a quarter-over-quarter basis, the last 4 quarters, they've actually been growing slower than 6%, around 5 point. Okay, so I would guess last quarter they grew at 1.2%. Previous quarter they grew at 4.2%. Like I said, this framework, there's a lot of where do you want to put them? Less than 5? They're not low to declining. I think I can give them 0.5 over here, just for the very fact that you understand the business, that they are in transition and they are inflecting upwards, right? So I'm going to give them 0.5. Although the last 2 to 3 quarters, they are really, really skinning the edge of this number over here. Optionality, yes, they do have multiple scalable revenue streams, easy to pivot into new total addressable market, not true. I think they have one dominant revenue stream, right? The rest of the things right now are smaller bets. So 0.5 over there. Customer concentration, definitely, I don't think they have customer concentration. That's not a problem. Gross margins. This is basically their transaction margin dollar. Let me take a look. I've never calculated that. What's their transaction margin dollar? I guess this is a little bit like contribution profit for SoFi. Let me take a look. Gross margin. It's around 46% if you are looking at that. Okay, that's not too bad. 46%. Yeah, I think that's not too bad. Moderate gross margins. Are they strong? Okay, I don't think they are on an increasing trend. I think they will be. And once I see that, then I will give them a higher score. But for right now, I feel comfortable with saying moderate gross margins relative to industry with stable trends. Because I think in fintechs in general tend to have a gross margin of between 40 to high 50, 60%. They're right smack in the middle, or slightly, in fact, slightly to the lower side. So I think 1 point is fair over here. Operating leverage, strong cost control. I think the new management have shown that. So I don't have a problem giving them 1.5 over here. Now, balance sheet. They definitely they don't have more cash than that. Right, they don't have more cash than that. Correct me if I'm wrong. Yeah, they don't. But goodwill is definitely less than 30%. So manageable debt. Yes, 1 point over here. If I'm not mistaken, because if I look at the DCF that we did, cash was around $10 billion. Debt was $11.2 billion. Right? Yeah. So I mean, they more or less have enough cash to cover the debt. But they are free cash flow positive, so that is definitely a good thing. So that's not a problem. Sorry. So goodwill less than 30% of assets. Oh, yeah. So I think I've spotted a mistake. I need to change this later on. Then what I've done over here is that for a lot of these frameworks, right, what I've realized is that when I'm looking at financial companies compared to software companies, I can't use the same framework. So because of that, these numbers will automatically change. If they actually sense this as banking services, then instead of looking at debt and goodwill, we'll be looking at the capital ratio and asset quality. However, because PayPal is not a banking service, so because of that, we are looking at their debt management as well as goodwill. Now, in terms of cash flow, they are positive. Okay, I will put them over here right now. They are negative, but or they are positive but not growing. Previously they were, but because they're reinvesting into the business, there is still a risk over there that this investment doesn't pay off. So despite the fact that they had positive and growing free cash flow, I think now they deserve to be over here. As they transition over, as we start to see signs of that transition pay, then we can increase this score again. Again, this second part is for banks. Instead of you looking at cash flow, we look at net interest margins. Again, this is not for PayPal. CEO, like I said, Alex Chris, I like him. Experience, good track record with Intuit. So I wouldn't mind giving him a 0.5 over here. Buybacks, definitely high buybacks. Do they have high insider ownership? Not really. Let me see. PayPal insider ownership. Yeah, not really. I think it's relatively low, around 0.08%. So no high insider ownership, but they do have high buyback. So 0.5. Score here, 1. Now, there's no presence of risk. yes, they're paying down their debt somewhat, not really. Exiting profitable, yeah. But I think right now, it's not that they're not working towards it. I think they're spending the money on redirecting the business towards growth. So, like I said, I think there's a lot of subjectivity when it comes into the discussion and the nuance around some of these discussions over here. Exit unprofitable segments, they have done so. So low to no risk with no action required. I think most of the unprofitable segment have been exited already. Diversified, there's no risk over here, no problem. Simplify operations, yes, they have done it already. Improve liquidity. I mean, not really. I think it's yeah. And then no unnecessary. Yeah, I don't think they're buying anyone anytime soon. So I think it's not bad. Core business can survive downturns. Strengthens and gain in market share. I mean, I think it's a little bit hard to judge right now. I think they did, yes, they benefit from the spike during the pandemic and whatever that came after that. But then after that, the CEO mismanaged the company. So I think yes, I mean they have been around years. I think it's say that they can survive downturns. Can they gain market share in downturns? I think they haven't shown that they can gain market share in downturns. I don't know. I'm not too sure. Some of you might want to give this 1 point. Some of you might want to give this 0. Strengthen and gain market share in downturns. I will be inclined to say it can survive downturns, which it has. Does it gain market share? It has probably gained market share in the past, but I think you really need to understand more in depth about the history of the company to understand whether or not it lost its market share because of the CEO or how badly it was affected during the various downturns. But it definitely can survive. So I'll be giving it 0 for now. This could really be because of my own lack of understanding. Okay, longevity, 10 years past, survive multiple cycles. And then you can see over here, okay, 23.5. It's not bad. It is a story-driven stock, which is, I think, more or less where we actually consider PayPal to be. Like I said earlier on, a story-driven company is a company that perhaps is in transition and some of the fundamentals don't yet support the story that the management is putting out, but they are already setting in place certain things that should drive growth for the companies in the quarters, in the years ahead. However, when we invest in a company like this, it is always very important to risk adjust our investment as a percentage of our overall portfolio, because some of these turnarounds can take much longer than we expected. So like you see, this turnaround for PayPal has already been 2 years since Alex Chris has been installed as the CEO, but they are only just setting the foundations in place for the turnaround to take place, and we haven't actually seen the results yet. So where this company sits, like I said, it's not a bad company by any stretch of the imagination, but it's also not a company that is growing. They are set up to grow, and we need to see evidence of that growth before we can actually make a further decision on the company. Now, finally, the last thing I want to do, for those of you who actually missed this on the live stream, you can actually go up to catch the entire live stream. And for those of you who are on the live stream, for those of you who are on the live stream, you have probably heard about me talking about this. Very quickly, I just want to end this by talking about the valuation of PayPal. So let me just show you this. And so finally, for those of you who were not on the live stream earlier, I'm going to show you the valuation for PayPal. Now, what we basically assume is that in 2025, PayPal grows their revenue at 6%, and then thereafter, the revenue growth slows down to 4% and 3% to the end of the decade in 2030, right? And then based on that, with cash flow margins coming in at around 25%, a slight increase from where they are today after they stopped reinvesting into the business, with CapEx spend steady at 2.5%. What you can see over here is that in terms of their cash, they have around $10 billion of cash and short-term investments on hand, and debts of around $11.29 billion. So with the 955 million shares outstanding, this brings their total share price or projected share price to $142. And then if you use the multiple method, and this is the perpetual approach, this is the multiple method. In terms of the multiple, if you apply a 12 times EV to EBITDA multiple, to the terminal multiple, I think what you get is around $113. So what I've worked out over here, the implied price for this company is that if you assume that they grow at these rates and achieve these margins, PayPal should be worth $128.03 today. Now, if you give them a further 10% margin of safety because you are unsure about the story playing out, then their price target should be around $115 today, and this represents a 66% potential upside. And with that, I'll see you in the next one. All right. Okay, wow. I just saw a couple of you are asking me about SoFi. How badly is SoFi down? Is there any news? I didn't see any news. I know they actually announced some payments with Lightspark, didn't they? At the start of, at market open today. SoFi's drop. Anything to do? Let me see. Oh, increased US bankruptcy rates. Oh, that definitely has something to do with it. I think I was doing the live stream. I didn't pay attention to the bankruptcy rates. Let me just let me take a look. All right, before I end, SoFi. I know SoFi is down because they're down 4%. I mean, they were up earlier, right? After that announcement with Lightspark. And I plan to talk about that in my next video, but okay, give me a second. Let me take a look. Economy. Where do you see the news on the increased US bankruptcy? Because today, all I see about SoFi is that they are rolling out Cash Coach to more people. They have a partnership that enabled cross-border payments and money transfers. And they actually announced that it will launch a blockchain-backed international money transfers through its app, right? And then in terms of the economy, housing starts, I mean, I guess. Oh, you were listening to Amit? I mean, I have to go and listen to him later on. I haven't listened to his live stream today, but I think if you are talking about the US bankruptcy rates, I think the market draws a correlation between US bankruptcy as well as SoFi. But if you take a look at SoFi's the consumer or the part of the population that SoFi goes after, they go after high people with very high credit scores, right? So if I'm not wrong, the average credit score in the US, let me see, yeah, the average FICO score in the US is around 710, 715, and SoFi operates at around, I believe around 750. So SoFi basically works with people with a FICO score above 700. Now, let me just pull this up for you. SoFi Invest. Sorry. SoFi Investor Relations. Let me stop sharing my screen over here. All right, let me share my screen over here for this is news on 6th of August. Oh, okay. I mean, I'll definitely go back and take a look. And I'm saying if that news came out on 6th August, it doesn't make sense that the market is only pricing it in today. But I think I'm just mentioning this because in general, should there be such news that come out, I wouldn't be surprised to see SoFi be affected by it because the market draws a correlation between bankruptcies as well as SoFi being a financial institution. But you have to dive a little bit deeper to look at how can bankruptcies affect them. Now, bankruptcies affect them if people don't pay back their loans, right? So now, if someone is on the brink of bankruptcy, right, unless there is something very unfortunate that happens to a person, let me just share my screen over here. This is basically the FICO score that SoFi operates in. I'm not too sure if you can see. Let me zoom this in. So you can see over here, they have indicated that as of 30th of June 2024, average FICO score 749. That's their overall average FICO score, 749. Personal loans 743, student loans 768, and then home loans 749 as well. Right. So I think from here you can see that yes, US bankruptcies might be rising, but it is unlikely that these bankruptcies are part of SoFi's ecosystem because of the FICO score that they operate in. For people with such high FICO score to go bankrupt, something really, really bad must be happening. And I don't think that this is something that that we have to be worried about, because I think in the past, especially in the last 2 to 3 years, and no worries, no worries. I mean, you can just leave it down in the comment and I'll take a look at it later on. But like I said, even in the past 2 to 3 years, when people were so worried about consumer credit, Anthony Noto and Chris Lapointe has always come out on the news, and they've always told us that they don't see such signs of weakness within the SoFi ecosystem because they go after these primarily high FICO score users. And I think this is a moat that is often discounted because people just assume high bankruptcy rates, high default rates means all banks and all fintechs will get hit together. However, they fail to account for the fact, and I think I've done comparison between companies like Upstart and Chime as well as SoFi in terms of the members that are on their platform. And with SoFi's members having in this really high FICO score, I don't think it is a risk. So when the market drops, especially over these kind of news, that's when I take it as an opportunity to dollar cost average personally. I mean, I'm not saying I'm doing it right now because I already have a sizable position. I think for me, SoFi is at a very nice position in the $23 range because in next week, I have 3 option contracts expiring on SoFi, right? I have $20 and $21 cash secured puts expiring 29th of August. And at the same time, I have $26 cash secured covered calls, expiring also on 29th of August. So if SoFi stays between $21 and $26 by next week, we are golden. Yeah, and correct. I think SoFi can offload the risk to other lenders. And I think what you are seeing and what Anthony Noto has said is that over time, they plan to move more and more of these loans onto their partners, right, through the loan platform business. And I think it's a little bit like what people were worried about previously. I think people were worried that with SoFi, when the interest rates were high, people didn't want to borrow. And then you can see companies like Upstart actually suffering because there were no people wanting to get a loan through Upstart. And however, with SoFi, that's different because they are the ones, they are the bank as well as the people doing the underwriting itself. So it's slightly different from Upstart because they hold that banking charter and they can decide to hold on to the loans and not have to sell these loans if it actually makes sense for them to do so. And like I said, they also have other aspects of their business that they can diversify during these times. So I'm not too afraid for SoFi when it comes to the financial side of things, because I mean Anthony Noto is really so experienced in this area that I have no doubt that they are able to manage it well. Yeah, so I mean I really have no idea. I think today is just, I mean, we have been having a largely green market leading up to August. August tends to be a weak time in the market, and I'm so surprised that even up to now, it took until 20th of August or even yesterday, 19th of August, that we start to see some volatility, some red in the markets. So it's not something I'm actually too concerned about. Yeah, so if you're worried about SoFi, I think to be worried about bankruptcies, not really an issue because, like I said, I pointed out the FICO score of the SoFi users are actually, yeah, in a very healthy range. Nothing to be worried about. Yeah, and I think if you see over here, yeah, they added this blockchain-based international money transfers, things I've talked about. I want to talk about this more specifically in another video, perhaps in one of the later live stream this week after I covered one of the companies, and then I'll start to talk about SoFi. But I think I've spent a lot of time already because at the start of today's live stream, I talked about why I did this, the framework and stuff like that. Got into the live stream, and then we're already an hour and 40 minutes in. Yeah. Okay. Wow. I really can yap for nearly 2 hours. So data-driven investing told us they launched Cash Coach. Fantastic. I really wish SoFi would come to Singapore. I think one of the things I was annoyed about is that when I first invested in this company, I was so excited because I knew they had a Hong Kong office, like even back in 2022. I was like saying, oh, you know what? I can't wait for this company to come to Singapore and then, I can use their product and see it. And it's quite amazing to me that Robinhood is actually coming here first. But my biggest position is actually in SoFi. And yes, I know SoFi is expanding internationally, but I think their focus now is Latin America more than Asia. But I mean, I think at the end of the day, I mean, yeah, I would hopefully one day be able to use their products. Yeah, but like I said, everything today is all good news. There's no reason why the stock would go down apart from algorithms. Perhaps some technical level, some people might sell at 25, but I don't think you can say that it got to 25 today. So I'm not very sure. I think you can, yeah. But I do think if you listen to the way Anthony Noto speaks about crypto and about banking in general, it's very safe to say that SoFi would definitely be one of the leaders when it comes to the crypto space, especially combining crypto and banking at the same time. And I believe the banking charter that many people actually give them crap for over the last years because they think that it somehow stifles the tech multiple. It's actually going to be something that is good for them when it comes to them expanding into the crypto space, being a regulated bank. When I go to the US, I'll try that. Hey, so Dia, where are you from? Oh, you're also from Singapore. Okay, okay. Yeah. Actually, you know what? I was actually saying that I'm thinking of going to the US next year because the World Cup is there and then you can go to the SoFi Stadium, but it's not too sure whether the timing will allow. Yeah. But yeah, I think that's about it. And then so tomorrow will be the second company. I'll keep that in suspense, and I will probably post a schedule to that live stream later on tomorrow morning, Singapore time, nighttime in the US, and then we'll see where we go from here. Okay. So I think with that, I will end the stream and I will see you tomorrow. See ya.